While you were watching silver crash from $90 and questioning every decision you have ever made, somebody was buying. Not small, not cautious, massive, strategic, nation-state level accumulation. And the data trail they left behind tells a story that will either make you very wealthy or very angry, depending on which side of this trade you are sitting on right now. Because what I found in the charts this week does not just suggest silver is going higher, it mathematically demands it. And by the time this video is over, you will understand exactly why $300 silver by summer is not a fantasy. It is a pattern that has played out twice before. And both times, the people who saw it coming changed their financial lives forever. Welcome to the hidden economy. If this kind of deep analysis is what you have been looking for, hit subscribe. I break down what mainstream financial media will not touch. And drop the word silver to the moon in the comments, so I know this community is paying attention. Let me start with something that has been bothering me for weeks. Silver broke above $50 for the first time in 50 years. Think about that. 50 years. Half a century. From 1980 to 2025, silver was trapped in a range between $4 and $50. Every single time it approached 50, it got slammed back down. 1980, rejected. 2011, rejected. And for 50 years, the financial world accepted that as normal. Silver is just a $50 metal. That is what they told you. That is what they told your parents. That is what every analyst on television has repeated for your entire life. But here is what nobody told you. During those same 50 years, gold did not stay trapped. Gold blew past its 1980 high. Gold blew past its 2011 high. Gold kept making new highs decade after decade. Copper did the same thing. Copper sat in a range of 50 cents to $1.50 for decades. Then it broke out in 2006 and went to $4.50. Lead did the same thing in 2007. Every single commodity that was compressed in a long range eventually broke through and repriced dramatically higher. Every single one, except silver. For 50 years, silver was the only major commodity held below its historical range. Do you understand what that means? It means the compression that built up inside this market over 5 decades is now releasing. And when 50 years of suppressed energy finally breaks free, it does not move 10%. It moves hundreds of percent. That is not my opinion. That is what the chart is screaming right now. Now let me show you something that changed my entire framework on this trade. I went back and studied every major silver surge in modern history, and I found a pattern so consistent it made me put down my coffee and just stare at the screen. 1979 to 1980, silver went from roughly $12 to $50. It quadrupled, and it did it in 5 months. Not 5 years, 5 months. 2010 to 2011, silver went from roughly $18 to almost $50, and more than doubled, and it did it in 7 months. Both of those surges happened within a couple of quarters, 5 months, 7 months. The explosive move, the part where the real money gets made, happens fast, not over years, over months. And both times, there was a sharp correction in the middle that shook out everyone who was not paying attention to the pattern. A jiggle in the middle, a scary, gut-wrenching pullback that made everyone say, "It is over. Silver is done. I should have sold." And both times, that pullback was the last opportunity to position before the final acceleration. Now look at what just happened. Silver started accelerating in November 2025. That was month 1. December was month 2. By the end of January, silver had surged above $90. Then came the crash. A brutal fast, day-and-a-half collapse that took silver back down and made every holder sick to their stomach. Sound familiar? It should, because this is the same pattern. Month 1, month 2, sharp correction, shakeout of weak hands. And if the pattern holds, which it has held twice before with remarkable precision, the real move has not even started yet. The majority of the gain, the part where silver goes from here to 300 or beyond, happens in months 3 through 6. That puts us at early summer 2026. But here is where it gets insane. And this is the part that separates this move from anything that came before. In 1980, silver quadrupled inside a $50 ceiling. The old range was 4 to 50, and the surge stayed within that range. In 2011, same thing. Silver doubled, but hit that $50 wall again. Both surges were powerful, but they were confined within the old reality. This time, silver has already broken through the 50-year ceiling. The old reality is gone. The $50 cap that held for half a century has been shattered. And even after that brutal crash, silver did not fall back below 50. It held above the old range. Do you see what this means? The floor of the new reality is the ceiling of the old one. Silver is not going back to the old world. It is building a launch pad on top of it. Think of it like a dam. For 50 years, water has been building up behind a concrete wall. Pressure increasing every year, every decade. Every attempt to breach the wall was pushed back, but the water never went away. It just kept building. And now for the first time, the wall is cracked. The water is not going to politely trickle through. It is going to blast through with 50 years of accumulated force behind it. That is what is happening to silver right now. The dam has cracked, and nobody can put it back together. Now I want to talk about something that most silver analysts are getting completely wrong, and it is costing their audience a fortune. Stay with me here, because this is important. After the crash, I saw dozens of prominent voices in the precious metals space announce that they had sold their entire silver position at $90. They pointed to their RSI charts, their momentum oscillators, their overbought indicators, and they said silver was overextended and due for a correction. And technically they were right. A correction did come. But here's the problem. They're using old tools to measure a new reality. It is like using a thermometer designed for room temperature to measure a volcano. The instrument was not built for this. RSI hitting 80 on a monthly chart used to mean overbought, used to in the old range. When silver was trapped between 4 and 50, those readings made sense. But we are not in that range anymore. The annual momentum charts I pulled show that silver has already blown past the momentum levels that marked the 2011 high and the 2020 surge high. The old ceiling on momentum has been broken just like the old ceiling on price, which means anyone using old overbought metrics to time their exit is going to miss the largest move of their lifetime. And here's the cruel part. Once they sell, the psychological barrier to getting back in at a higher price is enormous. Most of them never will. They will watch from the sidelines as silver does exactly what copper did after its multi-decade breakout. They will be right about the correction and catastrophically wrong about the trend. There are 3 types of people watching this video right now. The first type sold during the crash and is hoping I am wrong so they can feel smart about their decision. The second type held through the pain and is looking for confirmation that they are not crazy. And the third type has been watching from the sidelines, waiting for the perfect entry, and is now realizing that the perfect entry might have already passed. Whichever one you are, the data does not care about your feelings. It only cares about the pattern. The pattern says we are in month 2 of a 5 to 7 month surge that historically produces triple-digit percentage gains. Now, let me show you something that nobody in mainstream media is talking about. And this is the part that took me down a rabbit hole I did not expect. I pulled up the Shanghai silver price and compared it to the New York COMEX price. And there was a $30 gap. Shanghai silver is trading $30 per ounce above the Western price. $30. That is not a rounding error. That is not a temporary glitch. That is the physical market telling you that the paper price is a fiction. Go ahead. Google Shanghai silver premium right now. Pause the video if you need to. Look at the number yourself. Because when you see it with your own eyes on a screen that is not mine, it hits different. That gap is real. And it is widening. In my last video, I showed you that China has implemented export controls on silver as of January 1st, 2026. Only 44 state-approved companies can export. 60 to 70% of global refined silver supply is now trapped inside Chinese borders. And the result is a $30 premium in Shanghai. But it is not just China. I have been tracking reports from bullion dealers across North America, and some of them are now telling clients they may receive $10 to $15 below spot price on physical silver deliveries. Read that again. Dealers cannot get enough physical silver to fulfill orders at market price. They are warning clients in advance. That is not a healthy market. That is a market where the price on your screen and the price in the real world are 2 completely different numbers. And every single time in history that physical premiums have widened like this, the paper price eventually catches up, not the other way around. The paper price rises to meet the physical reality. It has never, not once, worked the other way. So when you see silver quoted at whatever the COMEX says today, understand that the real price, the price where actual metal changes, hands in the world's largest consuming nation, is $30 higher. That gap has to close, and it closes by the Western price going up. But that is not even the craziest part. Remember when I told you that silver rides on 2 waves? This is critical. Most people think silver is an industrial metal, and they are half right. Silver goes into solar panels, AI infrastructure, electronics, medical devices. China produces 80 to 90% of the world's solar cells, and silver is essential in every single one. The global supply deficit has not been satisfied for 5 consecutive years. Demand has exceeded supply every single year since 2021. And here is the thing about industrial silver. Once it goes into a solar panel or a circuit board, it is gone. Forever. The amounts are too small to recycle economically, so every ounce used industrially is an ounce permanently removed from supply. That is wave 1. Wave 2 is the one that changes everything. Silver is money. It has been money for 3,000 years, not 300. 3,000. And right now, something extraordinary is happening. India's Reserve Bank has issued regulations allowing silver to be used as formal bank collateral, effective April 1st, 2026, That is the first remonetization of silver by a major economy since the 1800s. 1.4 billion people are about to gain access to silver as a recognized monetary asset. This is not speculation. This is a regulatory fact published by the RBI. And here is what makes this explosive. When silver acts only as an industrial metal, its price is driven by factories and supply chains. Predictable, manageable. But when silver acts as money, when 1.4 billion people start treating it as a store of value, the demand curve goes vertical. Gold has been riding this monetary wave for years. That is why gold keeps making new highs. Gold is the mother metal of the monetary system. But silver is gold's baby brother. For 3,000 years, silver has followed gold, just with a lag. And right now, the lag is the widest it has been in modern history. Silver is absurdly cheap relative to gold. The gold to silver ratio is still near historically extreme levels. Every time this ratio has been this stretched, silver has violently repriced higher to close the gap. Not slowly, violently. So you have two massive demand waves converging at the same time. Industrial demand that has overwhelmed supply for 5 straight years. And monetary demand that is about to be unlocked for 1.4 billion people. Both waves hitting simultaneously. And the supply side is actually shrinking because China just locked 60 to 70% of refined silver inside its borders. This is not a setup for a 10% move. This is a setup for a paradigm shift. Now let me connect the dots to the broader financial landscape, because silver does not exist in a vacuum. And what I found here is what convinced me that $300 is not just possible. It might be conservative. I pulled up the US dollar index going back to 2010, and the long-term momentum trend is broken, not bending. Broken. The dollar has slipped below a structural support line that has held for over a decade. Now, the dollar is not collapsing overnight. It is a slow decay. But when you look at the M2 money supply data, you can see that every single decade, the money supply increases by 80 to 90%. That is not conspiracy. That is Federal Reserve data. Every decade, they print 80 to 90% more dollars, which means the purchasing power of each dollar drops decade after decade. And precious metals are the mirror image of that decay. When the dollar weakens structurally, gold and silver do not just go up. They reprice to reflect the cumulative loss of purchasing power that was hidden during the strong dollar periods. That repricing is happening right now. But wait, there's another factor, and this one genuinely worries me. In a good way for silver, in a very concerning way for the broader economy. The government bond market is cracking. I looked at US Treasury bond futures, and they are trading around 115. Recent lows hit the 113s. And here's the line in the sand. If bonds drop about 3 more points into the 112 range, the holding pattern that has kept bond prices stable since the 2022 collapse breaks down. And when that breaks, the US bond market starts to look like Japan. Japan is already in crisis mode. The UK bond market is under stress. Government debt globally is at levels that are making even the most conservative investors nervous. Jamie Dimon himself said months ago that you cannot keep pushing this down the road. When the average citizen who used to feel safe putting money in government bonds starts to have doubt about that safety, that is, and I am not being dramatic, a nuclear event for the financial system. Because if you cannot trust government bonds, where do you put your money? For 3,000 years, the answer to that question has been gold and silver, and that answer is coming back. And here's what ties it all together. The commodity complex is breaking out. I pulled the Bloomberg Commodity Index, and it has broken above a massive long-term momentum base. Crude oil just triggered a breakout that our analysis says ends the 2-year depression in energy prices. If crude goes from $60 to $90, and 90 is not even expensive by historical standards, since we were at 130 in 2022, that is a 50% jump in gasoline prices. Wheat has joined the breakout too. When commodity prices surge, the average consumer gets squeezed. Cost of living goes up. Inflation expectations rise. And the monetary metals, gold and silver, become the only logical shelter. And here is something that should make every stock market investor very uncomfortable. I compared the S&P 500 to gold and silver over the last 4 to 5 months. The S&P is sideways. It has been banging its head against 7,000 and going nowhere. Meanwhile, gold and silver, even after their pullback, are dramatically outperforming stocks over the same period. There is a massive asset class rotation happening right now. Money is quietly moving out of paper financial assets and into hard assets, commodities, energy, and above all, precious metals. This is not a one-week trend. This has been building for months, and when the average investor finally notices, which they always do last, the flood of capital into silver will be unlike anything we have seen in our lifetimes. Do you see what is happening? Dollar breaking down. Bonds cracking, commodities breaking out, stocks going sideways, physical silver premiums at $30, industrial deficit for 5 straight years. India remonetizing silver, China locking supply inside its borders, vaults draining across 3 continents. I have been studying markets for years, and I have never seen this many converging signals on a single asset. This is not one factor pointing to higher silver. This is every single major macro indicator pointing in the same direction at the same time. Now, let me give you the number that made me sit back and take a very deep breath. Gold made its cycle low in 2015 at roughly $1,050 per ounce. In previous bull markets, gold has made an 8-fold move from its cycle low to its peak. The 1980 peak was an 8-fold move from its base. The 2011 peak was an 8-fold move from its base. An 8-fold move from $1,050 puts gold at $8,400. JP Morgan, one of the largest banks on the planet, just published a target of $8,500 for gold, the same number. When one of the largest banks in the world is publishing the same target that the pattern produces independently, that is not a coincidence. That is confirmation. And here is what that means for silver. If gold goes to $8,500 and the gold to silver ratio reverts even halfway toward its historical average, silver at 300 is not aggressive. It is the mathematical midpoint. Silver at 500 becomes the upper range of what a full normalization would look like. And remember, the explosive part of this move, based on the 1979 and 2010 precedents, happens within 5 to 7 months of the initial breakout. We are in month 2. Now, I need to be honest with you about risks because I am not here to sell you a dream. I am here to show you data. Silver is volatile. The crash from $90 proved that. If you're using leverage, you can get wiped out on a pullback even if the long-term direction is up. Mining stocks can drop 50% in a correction even during a bull market. Timing is brutal and nobody gets it perfect. There are also scenarios where the pattern breaks. If governments aggressively raise interest rates, if there is a deflationary shock, if China reverses its export controls, the thesis weakens. I do not think any of those are likely based on current data, but they are possible. This is not financial advice. This is pattern recognition applied to publicly available data. What you do with it is your decision. But here's what I keep coming back to. Let me paint you a picture of what the next few weeks might look like based on the pattern. February is the stabilization month, the arm wrestling match. Silver bounces, pulls back, bounces again. It feels frustrating. It feels like nothing is happening. But underneath the surface, the structure is rebuilding. The 3-month moving average is holding. Short-term buy signals are starting to trigger. If silver reclaims the upper 80s this week or next, bears are in serious trouble. By March, if the pattern holds, silver challenges its recent highs again. And that is when the game changes, because the second time silver approaches a high after shaking out all the weak hands, there is no overhead resistance left. Everyone who was going to sell has already sold. The only people left are buyers. And that is when the acceleration kicks in. March through June, that is the window. That is where the 1979 pattern produced a quadrupling. That is where the 2010 pattern produced a 2.5 times move. And this time, the starting point is not $12 or $18. The starting point is the highest base silver has ever launched from. Above the 50-year ceiling, with every macro indicator aligned, with physical premiums screaming that the real price is already much higher than what your screen shows. 5 years from now, you're going to look back at this moment. You will remember the crash from $90. You will remember how it felt. The doubt, the sick feeling in your stomach, the headlines screaming that silver was done. And you will either remember it as the moment you panicked and sold, or you will remember it as the moment you looked at the data, saw the pattern, and made the decision that changed everything. Silver was trapped for 50 years. 50 years of compression. 50 years of being told it could not break $50. And it broke. It shattered that ceiling, and it has not gone back. Even after the worst crash in years, silver is still above the old range. The floor of the new reality is the ceiling of the old one.